Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient? And does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening. And of course, the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash. So there's a good reason to think that this will continue to be a reasonably strong economy. Now, the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that. And that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus, and you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.